We're all watching the markets close, and what is your reaction? And should we all be terrified?
So it's definitely been volatile to say the least, and unfortunately volatile to the downside. We all like the volatility when it goes the other way. And so yeah, it's in the long run, no, we don't need to be too worried yet. Obviously, in the short run, we're driven by, news, what's going on from the White House and from the political side, every single day or every hour, it seems like. And likewise, there begins to be worries about with cuts on the employment side, particularly on the government end, what does that do to the economy, consumer spending? Those are the kind of issues that are really driving the market. Are tariffs on today, or are they back off? So that uncertainty is really what the market doesn't like.
How long can we expect to ride this kind of wave of uncertainty? I know you don't have a crystal ball, but I know there's been a lot of sell-off lately. What do you anticipate?
Yeah, so you're exactly right, though. Unfortunately, in the short run, there is no crystal ball. We know there's a few dates that Trump has sort of thrown out there as it has to do with tariffs, but we also know that those dates have been fluid, to say the least. So April 2nd is when they've talked about basically having sort of all the tariffs in place. But as we've seen with Mexico and Canada, even twice now, that we've talked about putting them in place, then backed off for a month, then put them in place, but then excluded a whole lot of things for another month. And so, unfortunately, I think from that environment, we're probably in for some ups and downs for certain here over the rest of the month. But it also says when we look at the market in both a little shorter term, it doesn't go straight up or straight down, for the long run. So it tends to be, particularly if we get a big sell-off like today, there's usually some relief, some bounce at least that comes in the not too distant future, but neither of those really spell out to say where's the market going to be 6, 9 months from now. Those are some of the bigger economic issues that we got to keep in mind beyond just what was in the news today.
I know investors with an iron stomach are going, okay, tomorrow's another day. For those of us who are less financially savvy, like myself, you look at your portfolio and go, okay, what do I need? What do I need? What moves do I need to make? What's your advice to people, the everyday person investing in a
Yeah.
401k or what have you? What's your advice to folks as they watch the markets close as they did today?
So there's a couple of basic things that hold through all the ups and downs of the market. I mean, one, if we talk about people that are still working, still putting into a 401k. I mean, the simple answer on that regard, with regards to contributions, particularly if you're getting a company match, stick with it. Meaning, don't stop contributing to your 401k just because the market has a bad week or a bad month. In the long run, adding money to it and investing time in the market is actually more important than trying to time the market, every single day. In the bigger picture, it's really sort of sticking to your plan. And this is either where an advisor, if you're not, comfortable doing it all yourself, some type of professional helps. Because when we say sticking to a plan would really mean what are your goals for retirement? Meaning, what's the time frame? How much can you afford to risk? Because one other tenet we'll touch on in just a second is this idea of diversification, but not having all your eggs in one basket. So the plan should basically dictate how much risk are you willing to take? What are you comfortable with, but also what can you afford? So there's two answers to that risk question. And what's your time frame? And ultimately, what kind of return do you need? Because the other thing that we're actually in a fortunate spot today, interest rates are still pretty high. And so there's actually a fair number of pretty conservative investments that are still paying in that 7, 8, 9% range. Now, they're not going to pay that way forever. Obviously, as rates eventually come down, those will too. But safe money is actually paying a pretty good rate, today. So how much do you need to have in the market? How much risk are you taking is the key tenet there. But the last, as we kind of mentioned, diversification. I mean, most people think of that as, well, I just own a bunch of different stock or a bunch of different funds, different ETFs. But the reality is you need to take a little deeper look and say, how much of that is really in the market, in fixed income, in fixed accounts, in cash. Could be for some people, it's in real estate. For some people, it's in gold and silver. For some people, it might be crypto. Now, be careful, I'm not endorsing all of that, but in looking at it, real diversification says you own different types of investments that behave differently. And for many people, as we look over the last 2, 3 weeks of this down market, we say, yes, As of today, the Nasdaq's down about 14%. Here in the last, not quite 3 weeks, S&P is down about 7. Dow's also down about 6.5 to 7. But portfolios that can be pretty balanced and saying they got fixed income, other things, they may be down, 2 to 3, not 14, not double digits. So that's where diversification is critically important. And the last, as you kind of mentioned in the beginning, if somebody's kind of a novice to this or they don't, okay, how do I do it? Well, your best bet is probably working with some kind of professional, a financial advisor, a CPA, if they've got the background, somebody you trust. It's like, one, ideally, they should be a fiduciary. I mean, their job is to work for you. Their job is not to sell you a product or sell you something. And then two, says, can they work with you to develop that plan? Plan you can stick with through sort of the good and the ups and downs of the market. Because one of the things at Outlook Wealth, when we help people plan for retirement, we're not allowed to promise much in this industry, but I can just about promise somebody that over a course of 20 or 30 years in retirement, there's going to be a recession. There's going to be a bad year, a bad time. So having a plan that works not just when the market's good, but when the market isn't so good, as well. And frankly, historically speaking, yes, we've given some back the last 3 weeks, but it was only the middle of February we were at an all-time high. So if somebody doesn't have the plan, doesn't have some of this figured out, it's still a pretty good time to get some of these things in place.
Awesome. 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 Anything that I didn't ask that you think is really glaring in light of today's news?
Well, if we had to look at your question about, well, when may things sort of let up, or what are the key things kind of driving the market right now, I can kind of leave with just a couple. One is obviously what's going on with tariffs. So the more we're back and forth on and off, the more the market gets upset. The other is looking at news from the Federal Reserve. So Powell spoke just the other day. He said, in general, the economy is still in good shape, but they're not cutting rates anytime soon till they see what happens on tariffs, see what happens on the consumer price index. So that's the other. It's like, what's the news coming from the Federal Reserve? What's the news on consumer price index? Is inflation beginning to tick back up? And that's part of the worry. If we have a bunch of tariffs, well, then prices go up, which ultimately is inflation. And then the other is also looking at those consumer spending numbers, because at the end of the day, 70% of what the US economy does is driven by us as individuals getting out and being comfortable to spend the money. But if everybody tightens their wallet, stops spending money, that definitely has a negative for the economy and ultimately the market to go with it.